Hello, Engineered Wealth. This is Aaron Godwin. I am the Engineer of Wealth, and today we're going to be talking about what happens to the cash value upon my death. I had a client reach out to me. They had talked to another financial advisor, and the other financial advisor had given some bad advice. And so I want to just clarify that for everybody so that if you come across this, you will know what that answer is. So that question is that if I die, my family doesn't get the cash value, they only get the death benefit, right? While that is technically true, it is a very misleading statement to be said by that financial planner. So we're going to dive into that and look at that. So first off, there are different components available inside these accounts. One is the death benefit. All right, so one is the death benefit. My stylus is going a little bit slow. Missed the A right there. All right, I'm writing and it's not showing up on my iPad what I'm writing, so I apologize for the poor handwriting. All right, the second thing is the cash value. Third thing is the money available in the Engineered Wealth account. And that last piece is the insurance that is paid up. Paid up additions are insurance that you've completely paid for. All right, so when we talk about paid up additions, it's insurance that's paid for. Whenever we look at these, we have to look at several different components within that so that we can understand what is happening with that cash value. All right, so we're going to start off with somebody having a $500,000 benefit. So if we were looking at just plain whole life insurance, this is not supercharged like we do. This is not using the paid up additions to their full benefit. This is just looking at a straight traditional whole life insurance. You're going to have $500,000 in death benefit, $500,000 or zero in cash value, zero in the Engineered Wealth account, and zero available in paid up additions. Now, whenever we look at supercharging these, we are looking at lowering the death benefit and maximizing those paid up additions to the full extent. What happens then is we are putting more cash value into it so that we have access to that cash value within the Engineered Wealth account. So what we're going to do is we're going to just put a little bit of money into that to see what that would do. Right, so this person has a death benefit of $500,000, zero cash value, zero in the Engineered Wealth account, zero in paid up additions. This person decides that they want to start saving an additional $500 per year into this account. So they say that they want to save $500 per year into this account. We are adding $500 to the premium. What happens to the cash value? That cash value is $484, right? The insurance company cannot just give you dollar for dollar into that cash value because you are purchasing paid up additions. So those paid up additions are insurance that's paid up, right? So you never have to make an additional payment to that insurance again, and you could, if you were to do reduce paid up, you would have that benefit for the rest of your life. So within that Engineered Wealth account, if you chose, you could use $484 of that cash value within your Engineered Wealth account. Now, the paid up addition part, you're purchasing life insurance that gives you the availability to spend cash, right? What that looks like is that paid up addition is $2,076. So you paid $500 and you got $2,076. So if you were to die that next day, your family that $500 would turn into $2,076. So that would be a 400% rate of return on that next day. Right? So since this financial planner brought up that you don't get the cash value, you get the death benefit, that's exactly what you want. You want, instead of getting your $484 back, you want that insurance that you paid for. You get $2,076. Now, you're also paying for death benefit with your premium. And so what happens is your death benefit goes up, right? With that paid up addition, you were already paying premiums for $500,000, and whenever you did that paid up addition, you added an additional $2,076 to that life insurance contract. Right. Now, Aaron, why does this matter? Right? Why does this matter? Well, you have to purchase a commodity, right? So that commodity is insurance, and the second part is we are able to use that cash value for other things. Right? Whenever we're looking at supercharging these, we want to put as much cash value in these as possible so that we can use that cash value, so we can build upon it, right? So we can have uninterrupted compounding interest. If you were to choose, right, to take out $400 from your engineered wealth account, right? So that would be the credit available to you if you were to take a $400 loan from that credit available to you, and then you were to pass away that next day, what would happen? Right? Your family would get the full $502,076 minus $400, right? Minus $400. So your family would get $501,676 of that death benefit. So that is how the cash value works. That is how the paid up additions work. In order to meet those government guidelines, right, we used to be able to put just as much cash value into these as possible. Back in 1988, the government said, hey, this is too good of a deal. You have to be purchasing some amount of life insurance. And so that's how the modified endowment contract came into being. And then the insurance companies use these paid up additions so that you can put additional cash in there so that you can have that cash available to you. And so it's just as good of a deal as it was back in 1988. We just have to add some additional wording into it so that we can meet those government contracts and government regulations. I hope that's helpful. I hope that explains this well. So whenever somebody says, hey, whenever you die, they're going to pay you the death benefit and not the cash value. That's true, because your $500 was multiplied by 4, right? Your $500 became $2,000 of death benefit. So you want that $2,000 of death benefit as opposed to just looking at the $484 of return of premium. Right, that is a common misconception, especially with insurance agents that primarily sell term type insurance. They think that whole life and these paid up additions are similar to term with return of premium on them. They are not. They are buying additional life insurance, and so you have that ability to use the cash value inside of that in order to meet your other financial goals. I hope that is helpful. I hope that explains it well. I hope that fully answers the questions that are out there. If you have additional questions, shoot me an email, reach out to me via a voicemail. I would love to answer those and help you any way that I can. This is Engineered Wealth with Aaron Godwin. I am the Engineer of Wealth, and I look forward to talking to you soon.